Okay, so we're going to spend 2 videos going through how to prepare a cash budget, and we are going to call it quits at that point with this chapter. Um, I want to first emphasize, right, that a cash budget is not the same as a budgeted statement of cash flows. We didn't really spend a ton of time on the statement of cash flows in financial accounting. Um, it's a financial statement that is provided to outsiders, that separates all the cash flowing in a business into operating and financing and investing cash flows. That is not what we're going to do here. Okay, we don't really care about that for our budgeting purposes. What we are interested in is, are we going to have enough cash on hands on a general basis through the year to meet our obligations? Cash is king. A company can be turning a profit, but if they don't have cash in the bank to pay their bills when they come due, they are out of business, right? So the cash budget and learning how to prepare a cash budget is the single most important thing that is the outcome of all of this, all of these exercises that we've been doing through this chapter. So, we are really just going to focus on a cash budget. We are not going to look at creating budgeted balance sheets. We are going to take as given our capital budget, our capital expenditures, and we aren't going to go into a lot of detail in this class about how to do a capital budgeting analysis. That's something for a finance class, so which you'll get in Management 319. So I've already gone through all these points. Often as a business successfully produces and sells product but fails because of timing product problems associated with cash inflows and outflows, right? So as I said, because the cash flow is the lifeblood of an organization, the cash budget is one of the most important budgets in the master budget. Okay, so basically, right, this is how a cash budget should look. Of course, it's a lot more detailed than this, but you start out with some beginning cash in the bank, in this case $3,000. You add in whatever you bring in terms of cash. In this case, it's 45. That means you have a total of $48,000 cash in the bank that's available. And then you disperse cash, you pay your bills, and that's how you end up with your ending balance in cash. So, this is the same structure as all these other, you start with something in the beginning, you add new, you subtract what you use, and you get to an ending. It's always the same, right? Okay. Now, the thing is, right, your cash available comes from whatever you started off with at the beginning of your business year, the cycle that we're budgeting for, and then all of the cash receipts that you get. And remember, not all sales are necessarily in cash, right? If you purchase many things, you pay part of it now and part of it later. And so usually for businesses, and particularly for manufacturing businesses, a large proportion of sales is on account. That means that it's not cash sales, right? If you're a merchandiser and you're selling pants, sure, those are all going to be cash sales. But if you're a manufacturer and you're selling to other businesses, they're going to have an account with you. So we need to pay attention to when we get paid. Now, we can make some assumptions based on our past history as to how fast people pay, how quickly people pay, and this creates what's called a schedule of cash collections on accounts receivable. So let's go ahead and go into our example, and you guys know the drill, right? Here is our, I'm going to unhide the sales, right? So these are our sales. I made a new page in this spreadsheet because the cash budget is kind of complicated. So these are picking up from the other page, right? So here's our sales numbers. And our assumptions are that, first of all, that we have a beginning accounts receivable balance of $1,350, and we're going to pick that up at the beginning of the first quarter. And then our other assumptions were given in the prior page. And so this you have to kind of hold this all in your head. Well, you write it down actually, but let's pay attention to what it's saying. 25% of total sales are for cash, and 75% of sales are on credit. And out of those credit sales, 90% of those are going to be paid during the quarter that the sale was made. So if you buy something in January and you don't pay cash for it, 90% of the customers will have paid off their bills by the end of the quarter. Okay, and the remaining 10% are paid in the following quarter. Okay, so I have written down all these assumptions like before. So we'll give those some black font, right? So here's our $1,300, $1,350 collected in quarter one of the coming year. 25% of the sales are for cash. 75% are on credit. 90% of the credit sales are paid in the same quarter in which they are made, and 10% are paid in the following quarter. Now, this is how your textbook lays out their cash receipts budget, and so this is how I have done it. Personally, if I were actually making a business plan here, I would lay this out differently, but this is how you're going to see it in the example. So let's just go ahead with through the example. Okay. So our cash sales are going to be 25% of this quarter's sales. So that's easy, right? We pick up that 25%, make it an absolute cell reference, and then multiply it by this quarter's sales. Now, this is not the kind of setup where I can do a whole column and just copy it through for you, unfortunately. But this one line I can copy through. So there is our cash sales that we're expecting. And then we have to go manually through each of these cells and calculate what we want to put in there. So first of all, we're going to pick up $1,350 in quarter from last quarter, and then we are going to pick up 90% of 75% of this quarter's sales. So it's 90% of 75% of this quarter's sales we are going to pick up in cash in quarter one. And then we are going to pick up the remaining 10% of quarter one sales in quarter two. So that's 10% of 75% of quarter one's sales. We're going to pick those up next quarter, 750. We move on to quarter two. Right, this is how much we got in cash. We're also going to pick up 90% of the remainder. So 90% of 75% are credit sales of quarter two sales. That's $8,100, and then the remainder is going to be 10% of 75% of quarter two sales, and you get the picture, right? Move on to quarter three. Our credit sales that are paid in that month are going to be 90% of 75% of the quarter three sales. And we're going to pick up the remaining 10% of quarter three sales in quarter four. And then quarter four, we're just going to pick up that 90% of 75% of quarter four's sales. Okay. So these numbers are all the same as what we've got over here in the PowerPoint. So now all we have to do is add up our cash receipts. Now this one, if we are smart about it, we can go ahead and copy the calculation over. And so that is how you figure out how much cash you are getting in every quarter relative to what you're selling. So in our first quarter, you'll notice that we're getting more cash in than what we sold because we're picking up probably last Christmas time sales, right? But in the second quarter and subsequent quarters, we're getting a little bit less in cash than what we sold, okay? So that's why it's so important not just to look at income and profit, but also to look at cash receipts.